In our previous videos, we talked about interest rates and bond laddering, both strategies that work regardless of market conditions. Today, we're covering something even more fundamental: asset allocation by age. This is the single decision that will have the biggest impact on your portfolio's performance and your stress level. And the good news? There's a simple rule that's worked for decades. Let's break it down without the complexity.
Asset allocation simply means how you divide your investments between stocks, bonds, and cash. According to SoFi's August 2025 analysis, it's an investment strategy that helps you balance risk while aiming for the highest potential return within your time frame. The key insight: your age is one of the best proxies for determining this balance because it represents your time horizon, your capacity for risk, and your current life stage. A 25-year-old and a 65-year-old have fundamentally different financial needs.
The classic rule, according to Kiplinger's October 2025 guide, is so simple a first grader can do it. Subtract your age from 100 to get your stock percentage. Age 30, 70% stocks, 30% bonds. Age 60, 40% stocks, 60% bonds. This gradually reduces risk as you approach retirement. If you're 30 and the market crashes 40%, you have decades to recover. But if you're 65 and lose 40%, that's devastating. This rule has been the foundation of retirement planning for generations.
But here's the modern update. We're living longer now. According to multiple 2025 sources, including Motley Fool and Financial Samurai, many advisors now recommend the Rule of 110 or even Rule of 120 instead. Subtract your age from 110 or 120 for a more aggressive allocation. Why? Because retirement can last 30+ years now, and your money needs to keep growing. At age 30, using the 120 rule, you'd have 90% in stocks. Even at 70, you'd maintain 50% stocks to combat inflation.
So which rule should you use? Waterloo Capital's October 2025 analysis says it depends on your risk tolerance and situation. Rule of 100. More conservative, suitable if you're risk-averse or have other income sources. Rule of 110. Middle ground, recommended by T. Rowe Price and embedded in many target date funds. Rule of 120. Aggressive, for those with higher risk tolerance and longer expected lifespans. My recommendation for most beginners? Start with the Rule of 110. It's a solid middle path.
Let's get specific by age. In your 20s and 30s, according to SoFi and Waterloo Capital, your greatest asset is time. With decades until retirement, you can afford higher risk for higher returns. Using Rule of 110, a 30-year-old would hold 80% stocks, 20% bonds. Some experts, like Stephen Connors, even say 0 bonds at this age if you're 20+ years from retirement. The key is staying invested through volatility, because you have time to recover from downturns.
In your 40s and 50s, T. Rowe Price's November 2025 guidance suggests maintaining growth while adding stability. You still have 10-20 years of working years left, so stocks remain important. Using Rule of 110, a 50-year-old would hold 60% stocks, 40% bonds. This is the transition phase where you're shifting from pure accumulation to preservation. T. Rowe Price specifically notes, add a meaningful allocation to bonds in your 50s while prioritizing stocks' long-term growth potential.
In your 60s and retirement, Charles Schwab and Waterloo Capital emphasize you still need growth. Retirement can last 30+ years. You must outpace inflation. Using the Rule of 110, a 70-year-old would hold 40% stocks, 60% bonds. Many retirees use a bucket strategy: cash for 1 to 2 years of expenses, bonds for 3 to 7 years, and stocks for 8+ years. Bill Bengen, creator of the 4% rule, recommends maintaining 60-40 stocks, bonds, in retirement. Don't abandon stocks completely.
Why does this age-based approach work? Because it matches your capacity for risk with your time horizon. Optimized Portfolios analysis explains, younger investors can handle market swings because they have decades to recover. As you age, your ability to weather downturns decreases because you're closer to needing the money. The gradual shift from stocks to bonds isn't about being scared, it's about being strategic. You're reducing volatility as your recovery window shrinks.
Here's the maintenance part. Rebalance at least annually. SoFi's guide recommends whenever an asset allocation changes by 5% or more. For example, if you're targeting 70-30 stocks bonds, but stocks had a great year and you're now at 80-20, sell some stocks and buy bonds back to 70-30. Your birthday is a perfect trigger to review. As T. Rowe Price suggests, it's also when you need to adjust your target allocation as you age.
Important caveat from Financial Samurai and Waterloo Capital. Age isn't the only factor. Your personal situation matters. Have a pension? You can afford more stock risk. No other income sources? More conservative makes sense. Own rental properties? Your real estate acts as bonds, so your portfolio can be more aggressive. Have high risk tolerance? Adjust upward. Low tolerance? Go conservative. The rules are starting points. Customize to your situation.
Want the easy button? Target date funds do this automatically. SoFi and Motley Fool explain. Pick a fund with your retirement year, like 2050 or 2060, and it automatically adjusts allocation as you age. That's called the glide path. Vanguard Target 2050 starts aggressive and gradually becomes conservative as 2050 approaches. Drawback? They don't account for your personal risk tolerance or situation changes, but for hands-off beginners, they're excellent.
Common mistake number 1, going 100% bonds in retirement. Waterloo Capital's 2025 guide addresses this directly. This is a common misconception. Retirement lasts 20 to 30 years. You need growth to outpace inflation. Moving completely out of stocks is rarely right. Even at 70, maintaining 40 to 50% stocks is recommended. Your savings must continue growing. Zero stocks means inflation slowly erodes your purchasing power. Stay diversified even in retirement.
Mistake number 2. Changing allocation based on market conditions. Motley Fool's 2025 advice is clear. Follow a planned asset allocation strategy precisely because you can't time the market. If you let market conditions influence your allocation, you're not following a strategy, you're reacting emotionally. Set your age-appropriate allocation and stick with it through ups and downs. The whole point is avoiding emotional decisions. Market timing destroys returns.
Mistake number 3, overthinking the exact percentages. Is 70-30 better than 75-25? Does it matter if you're 72% or 68% in stocks? No. Charles Schwab emphasizes the allocation should provide you with peace of mind. The difference between 70-30 and 75-25 is minimal compared to the difference between having any plan versus no plan. Pick a reasonable allocation based on the age rules, stick with it, and focus on consistent contributions.
Here's your action plan. Step 1, calculate your target allocation using the rule of 110. 110 minus your age equals stock percentage. Step 2, check your current holdings. What percentage is actually in stocks versus bonds? Step 3, if you're off target by more than 5%, rebalance by selling the overweight asset and buying the underweight. Step 4, set an annual reminder on your birthday to review and adjust. That's it. Simple, systematic, stress-free.
Let's make this concrete. Say you're 45 years old with $100,000 to invest. Using rule of 110, 110 minus 45 equals 65% stocks. That means $65,000 in a stock index fund like VTI and $35,000 in a bond fund like BND. Done! You just properly allocated your portfolio in 2 transactions. As you get raises, keep that 65-35 ratio with new contributions. On your 46th birthday, check if you're still close to 64-36. Rebalance if needed. See how simple this is?
Bottom line, Asset allocation by age is the foundation of your investment strategy. Use Rule of 110 as a starting point. Subtract your age from 110 for your stock percentage. Rebalance annually on your birthday. Customize based on your situation, but don't overthink it. Combined with the interest rate strategy and bond laddering we covered in previous videos, you now have a complete beginner-friendly system. If this series is helping you, hit like and subscribe. Comment, what's your age and current allocation? Let's see if you're on track. Keep building that wealth the smart, calm way.